Ladies and gentlemen, welcome to today's webinar. Today's seminar presentation is Expatriation and the Permanent Estate Tax Taint of Section 2801. Our presenters today are attorneys Gary Forster and Brian Page. If you'd like a copy of today's presentation, you'll find it in the handouts section of the webinar interface. Similarly, if you would like to ask a question, you can type it into the question section of the webinar interface. And now let me turn it over to our presenters. Go ahead, Gary and Brian.
Thanks so much for attending today. We're today going to present a continuation of the tax impact of expatriation. It's a technical topic, but it's good, and we have mostly CPAs on the line. It's good to understand the issues and recognize when something that could create liability on expatriation comes up and how to plan for it, to be perfectly honest with you. What we found, both on expatriation and on this issue, the inheritance tax associated with expatriation, is if you can catch it somewhat early, maybe a year before someone plans to leave, the planning opportunities are immense. And in many cases, you can completely avoid the tax associated with expatriation. We're going to go to the slides now and look at the index. Going to the next slide. That's a number of things. We'll give you the background. Last month we went through the expatriation tax, which is a tax that's triggered upon someone leaving the country and either giving up their citizenship or giving up their green card after having been here 8 to 15 years. That's a exit tax that very few people are aware of. We find that especially with respect to non-citizens who come here and live here for a while, either be with their family or for a job under a green card, that going back to the home country and giving up the green card, that very few understand the impact associated with that and the tax trigger that occurs. Last month we discussed the mark-to-market deemed sale of all their assets when they do that. Beyond that, this presentation is the corresponding impact on a tax that's similar to the estate and gift tax called the inheritance tax, which never goes away. It's a very technical but interesting area. When someone leaves the country, either gives up their citizenships or their green card after having been here 8 years, they're subject to this inheritance tax, which pretty much prohibits them under a very severe tax penalty from bringing back assets into the States, back to, for instance, the child that stayed behind or a spouse that stayed behind in the States, without a substantial tax cost that wouldn't otherwise, in many cases, be suffered by a now non-U.S. individual. We'll go through the trap, the issues associated with the trap, the planning, how to compute the tax. If you can make it awake through that, we'll finish up with a conclusion and any questions. And I'm going to turn it over to Brian to start the technical side of the presentation.
Just a brief reminder and overview of what expatriation is, just so we have a foundation to move forward, to understand how the inheritance tax works and the mechanics and the logic behind it. But as Gary has already said, it applies to certain U.S. Obviously a U.S. citizen or the long-term residents, which are green card holders, 8 of the 15 years, who meet certain criteria, which relates to wealth, annual income, and then tax compliance. If your client is pulled into the net, then these things will apply. It's interesting because the expatriation tax itself, at least on the exit, is an income tax regime. under subtitle A, but the inheritance tax is under subtitle B. And it's interesting because of the interaction of how it works, and basically it's double taxation. If you're covered and you leave, and then you make a gift to a U.S. resident, you're going to have this inheritance tax that's always there, even on newly acquired property that the covered expat might have gotten after they left the United States.
It's a very onerous imposition of tax on assets coming into the U.S. Typically, the tax code is not as concerned, if a tax code can be concerned, about the recovery of assets or the movement from abroad. Actually, we're looking at an asset import matter right now, and it looks like it's going to be fine, because the code in general, withholding wise, and a lot of the account basically disclosure issues are not as significant with assets coming in to the country, because the IRS loves when assets come into the country. This is an exception. This is a pretty heavy, onerous exception. When someone decides, okay, they're leaving, once they're gone and they pay that tax, that deemed sale of all their assets worldwide, it's very hard to get assets back, gifted back into the States without this, by avoiding this inheritance tax. So as we'll go through the slides, we'll try to give you an overview of some of the planning that you can do to avoid having to gift back assets after you've expatriated, because this tax really needs to be avoided.
What's also interesting is that, unlike any other tax that exists, on the inheritance tax side, the donee pays the tax, the person who receives the gift, not the person who makes the gift.
Yeah, the IRS is pretty particular if you're aware of a lot of the withholding regulations. For instance, if you've ever done a closing with a foreign individual, when people are gone or about to go, they want to strap the hands of someone in the States that they can get to, so that the penalty can be felt by someone who's here, and that they can enforce that penalty on someone located in the U.S. Once someone's gone, it's very difficult for the IRS to enforce. There are, for instance, tax information exchange agreements, treaties, and ways by which the IRS can identify and in some cases enforce tax deficiencies against people who are not in the country. It's a really completely different endeavor, though. It's much, much easier for them to handcuff someone who's in the States. And the way this inheritance tax works, the reason Brian brings it up in terms of the liability, it's the recipient, the U.S. recipient, that's subject to it and liable for the tax because they're here, simply because they're here. That's not the case in terms of the regular gift tax. If a U.S. individual is gifting out monies to their family or friends or whatever they're doing, it's the grantor in the U.S. That's liable for the tax.
Just as an overview again, I know this might be from before, but it's the exit tax. If it applies, it's a deemed sale of all the worldwide assets on the day prior to expatriation, and a deemed taxable distribution of IRAs, 529 plans, and HSAs. That's the exit tax on the income side. So even though in certain instances you might think that it's okay for your client, if it applies, you're going to have a deemed sale, and it's worldwide assets. So it's important to understand the ramifications of expatriation and the potential net of this tax. On the inheritance tax side, it's a 40% flat tax on the gross value of the covered gift or bequest made to the U.S. Benny. So it's basically the application without a credit of the estate or gift tax.
Right, and the planning can be combined. Sometimes the exit tax, if we don't have a very wealthy individual, We can give assets away to get them under. There is an income, net worth threshold. There's also an income threshold, but there's a net worth threshold about $2 million. If you can get the client under the $2 million, a lot of times the exit tax will not apply at all. And at the same time, you know, instead of waiting for the expatriation and then suffering this inheritance tax for assets coming back into the States, we can just give it to them before we leave. It's much, you can plan around this. Does anyone? Basically, no one plans around this because they're not aware of it. But you know, if you are a tax advisor and you do see either someone who's going to give up their citizenship, obviously that's very uncommon. But much more common is this non-citizen who's going back to their home country, and you have a year or two before they do it. It's very important to do the planning. It can be very effective. Often it's not very painful to do the planning, but once they're gone, that's the end of the planning.
It's pretty straightforward. If you expatriate and you're a U.S. citizen, you're able to do it. There are certain ways to do it. There are 4 different ways to formally renounce. There were 2 regimes. One was from 2004 to 2008. That barely applies anymore for the clients that perhaps those that had left during that time had not followed the steps. It was basically a 10-year taint on their assets, and then after the expiration of that, it would go away. But under the new one, which was effective in 2008, which is 877A, it's the deemed sale when you leave. That's
yeah. So I had mentioned this last month. Basically, the Clinton administration caught on to the idea that foreign people were actually investing in the U.S. And that we needed to stop that. So what had happened was, if you're foreign, if you're not a U.S. resident or a U.S. citizen at all, you have no connection to the States, you can trade U.S. stocks and bonds at no capital gains. It's not a very well-known thing. Interestingly, a lot of the foreign people that come in are more aware of it than even some of the U.S. tax advisors. There's no tax. There's no capital gains tax unless it involves real estate. So what would happen would be an individual in a certain business would come to the States, start the business here, grow the business, and then leave, no longer be a U.S. resident, and then sell the stock at no capital gains. And that did not make people happy in the federal government, especially with the IRS, because they wanted to try to attach that money. So in the late 90s, this 10-year idea, like, okay, you can do that, but you have to be out of the country for 10 years. There were certain ways around that. You could, in some ways, plan. And so what it developed, the law moved away from this 10-year idea to this idea that, look, if you leave, you've got to pay tax on everything as if you sold it all that at that time.
for non-U.S. citizens who's covered. It's a long-term resident, which means a green card holder who's enjoyed their U.S. residency for 8 out of the past 15 years, ending in the year of renunciation. It's interesting because it doesn't apply if you are a U.S. tax resident under the substantial presence test. So it's important that there's a distinction there.
That's not, in other words, that doesn't make you subject to the expatriation tax per se. If you're in a substantial presence and you get a green card, of course, and you're here 8 years, you're trapped. But that's right. If you're here a year, or you're here, even if you're under a green card, you're here 5 years, you're not trapped.
Right. And otherwise, it's also important to understand that just because the green card expires on its date on the card does not mean they have been formally relinquished. We've dealt with that before.
Well, a fascinating circumstance is fascinating to us, not to the clients, but is when someone's relinquished for immigration purposes. They no longer have the visa, the green card. the work permit, whatever. But the tax side hasn't been complied with. This we've seen this a few times, and it is a separate. It's related, but it's a separate and more onerous process, and you have to go through that in order to give up the card. So you give up the card, and then you're subject to the expat, mark to market, and this inheritance tax. If you don't give up the card under the IRS rules, you're out immigration wise. You're still taxed on your worldwide income. So it's kind of like you're damned if you do, you're damned if you don't. And that's why the planning is so important. Basically, the idea is plan, get around or try to avoid as much as possible the mark to market and inheritance tax, and then properly submit the green card.
The time of expatriation is important, less so now because of the dates, but it's when it actually occurs, and that's the regime under which you will be taxed. That's the important thing.
Yeah, it's phasing out that 10 years.
Yeah, the 877 now, I mean, it expired in 2008. We're basically 12 years from that point, so it's very rarely now, unless someone thought they left and they didn't. For the most part, we're under the new regime, which is 877A, which is known as the HART Act. Under the old one, we talked about it before. It's just a 10-year period following the expatriation. Now that we're so far out, it really doesn't apply anymore, but just need to be aware of it. It's also important because a lot of the definitions that are used under the new regime, 877A, are based on the 877 in the code. It actually refers to them, so it's important to understand it and know that it's there. Now, the exit tax for today. If you leave and you're covered, that means you fit under the criteria. You have a mark-to-market tax on your worldwide assets, and you pay tax on the deemed gain, even though it's not actually sold. And then we also talked about the inheritance tax on the other side, which is interesting. Before, this idea of an exit tax and the 10-year taint existed from the late 90s, but this idea of an inheritance tax was imposed in 2008. So Congress thought that there was arbitrage or the potential for cheating out the government of certain assets. The idea being that if you were a person who's going to expatriate, you could leave, pay your deemed sale, and then get back the asset at a stepped-up basis.
Yeah, I mean, you did pay the mark-to-market tax.
You did pay the tax, but they were afraid that you were trying to get around the estate tax because capital gains are much lower.
The rate's lower.
The rate's lower.
Yeah, the rate's lower. It's, I don't know. I think
that's what they thought, at least. That's how it was sold.
Yeah.
These are the three thresholds. It's any of these. If any of these are met, it applies. So if the net worth, even after planning, exceeds $2 million, the expat is pulled in. If their annual income tax liability over the 5 years is over 177, I believe, for 2020, you're pulled in. And then the last, if you fail, so even if your client does not meet any of the first two, if they fail to certify tax compliance, they're still pulled into this regime. So it's important that you file all the forms for income taxes and tax reasons as opposed to just for immigration, because they are separate and the rules are a little different. But if you fail to do it, your client is pulled into the net. Calculating the mark-to-market, it's pretty straightforward. Whatever the fair market value is, as if the expat died the day before expatriation, it does receive a basis adjustment, at least for U.S. income tax purposes. There is a $737,000 credit that you can apply against it, so you don't pay the tax. It's indexed as well to inflation. It will go up a little bit each year, but that's what it currently is. there are ways to defer the mark-to-market if you deem adequate security to wait till maybe the property's actually sold. That would probably be the main reason. And the most important thing to perhaps take away from this, it is possible for a green card holder to make an unintended expatriation.
By treaty, taking a treaty position.
Right. And that's something that we've seen, and they have no idea until after
That's
the
true.
fact.
Yeah, that's.
They're not happy.
You can bet on that.
Okay. That is the foundation of the exit tax, and so now we can get into the meat of what is 2801 and what does it do, how does it operate, and how do we calculate what the tax actually is. First off, this is a transfer tax, so it's found in subtitle B. So regardless of what happens in subtitle A, which is the mark-to-market, this is a transfer tax. And so the rules for transfer taxes as relates to who qualifies, where the individual is who receives, the donee, the recipient of the gift, are they a U.S. resident? All these things apply, and it's important to understand the rules. As we've said, it's a double tax on these assets. So if you have an expatriate that has left, they were pulled in and they paid the market-to-market tax, and then they later make a gift to a U.S. resident, this tax will apply.
Mm-hmm.
And as we've already said, the recipient will pay the tax. So, and we'll talk about that, and we'll also see how it's unfair in that even though a tax is paid, there's no step up in basis for the tax paid for the
it's crazy.
recipient.
It's absolutely amazing.
It's amazing.
Today we even had a matter where a group received from their home country 3 wires. And they were notified by the bank that the bank had reported that. So, and they have,
of course they did.
Yeah, I mean, the bank has an internal reporting mechanism, all the banks do. And then, so this group, my understanding is that they probably haven't had any background in taxation. They had immigrated some time ago to the States. Some are citizens, some are not citizens. The wire was to a related party, and that wire coming from outside the country will be reported to the IRS, and then will link to the federal ID number and both TIN and Social Security number of several of the parties. So the way this now works through the systemically, electronically, is that it's going to trigger compliance with a totally different seminar, but with, did they disclose their foreign accounts, their foreign properties, because it actually related to the sale of a foreign property. Okay, no, my initial impression from the group is there's been no disclosure at all. But now, do we have a situation where, grandma went back to the home country after being here for 8 years under a green card and is transferring cash back in to the kids? Well, number one, did she pay the mark-to-market tax when she left and gave up the green card because she doesn't want to be taxed on her worldwide income by the United States? My guess is she gave it up to ICE, but she didn't file any tax compliance documents. So she's probably still taxed on her worldwide income and not in compliance. If she did follow the tax compliance, which honestly, no one does, but it's kind of a shame that the government doesn't even just supply all that information to people, then she's an expat. And she's basically going to trigger tax to the recipient, to the families here, of that cash. And the IRS now knows about it.
Yeah. The also thing that's interesting about this, we like to call it a taint of 2801, is it never expires. So if you have a covered expatriate and it's 30 years later, under the current regime, if they make a gift to a U.S. resident 30 years later, it still applies. It never goes away. And it's
And on death as well.
death as well. That's right. So that's why it's a gift or bequest. A bequest would be a distribution from a trust or an estate on death.
Yeah.
The other thing is, right now the estate tax is only 40%, but if it goes up, which it can,
It's only 40%.
well, it used to
Yeah.
be much higher.
That'll wake you up though.
That'll wake you up,
40%.
Yeah. And the other interesting thing is we've already discussed is the recipient, even though they pay this 40% tax, they don't get a step. So you pay a tax, but you get no tax benefit on the asset.
I wonder, I haven't seen this, but I wonder if you're going to get a lot of these rejections. You know what I mean? I wonder if the people are going to start to say, no, I don't want it.
Well,
If they do it in the same tax year, I wonder if I haven't seen that, and who knows what the answer to that is, but that's
Interesting
probably going
enough,
to happen.
an exception to 2801 is a disclaimer. We'll talk about that.
Well, but I mean, the disclaimer makes sense.
At death, yes.
But it's going to be, for instance, we've got a group in Greece. Okay, so their disclaimer will trigger another kid in the States getting it. So it would have to be a series of disclaimers and then back to somewhere, to some nephew.
Outside the country.
I don't know.
A non-U.S. resident.
Yeah, who knows? That's going to be interesting.
Yeah,
be a lot of work for us. Yes.
What's also interesting is that this also applies to foreign trusts with U.S. bennies. So that's not a way to plan around it by the use of a foreign trust. If you have a expat who's covered, who they paid their market, and they tried to create a foreign trust for the benefit of U.S. bennies, it'll still apply not at the actual time of transfer, but when distributions are actually made to the U.S. resident.
Yeah, and wait till you see this little formula you've got to work through if someone has a foreign trust, because you're going to get pre-immigration assets contribute to the foreign trust. You're going to get post-immigration assets contribute to the foreign trust. It's quite an undertaking.
The other interesting thing is that this applies even if it's a foreign grantor trust. So even if the income tax rules apply and it's a foreign grantor trust, doesn't matter as it relates to 2801 because it's a transfer tax regime.
Yeah, the grantor, we've got mostly CPAs on the line, but the grantor tax regime basically creates a disregarded foreign trust where the actual foreign grantor is taxed on the income side. But this is an estate tax. This is not an income tax, so it doesn't matter. It doesn't make any difference.
We'll also see when you will calculate a 2801 ratio, just like you would have a GST ratio for a trust, and then based on the ratio, that will dictate how much of the distribution is taxed each time. And we'll go into that. We'll do an example. And then what's interesting is if the foreign trust wants to avoid this, it may elect to be treated as a domestic one,
which is an option, and that's an option also on a couple of different areas of tax law with respect to foreign trusts, where we have to deal with somebody coming back into the States. This is kind of similar in a way, right? Because we're moving assets back into the States. If we make the foreign trust domestic, it might avoid this. But wasn't that the whole idea to begin with?
Exactly. You can avoid the whole reason to get in here, and then you also subject all the assets in the domestic trust to U.S. income taxation.
Absolutely.
So you have to weigh which makes the most sense,
if any of it makes any sense.
Now we've talked very briefly about why this was done. There was this concern in Congress that there was some type of arbitrage going on, that people would abuse this because the capital gains rates are much lower. So someone would leave and then give stuff back to their U.S. resident family members and avoid the estate tax. That was the mindset behind it. But the problem is all of these rules have been overlaid on top of older law, and I don't think all of the consequences were thought through all the way, especially with the not getting a step up on the
you
tax
know what?
paid.
We've never seen that before with the IRS and tax legislation. that it wasn't completely thought through. Yeah, this is kind of, par for the course. So you have one issue, which is someone leaves, it's a deemed sale of their assets, but they get to step up into the fair market value, they pay the tax. And then Congress said, well, wait a minute, if they have to step up in value and they give it back to someone in the States, and then that someone dies, they don't, have this distinction. Or if they sell the asset, they don't have to pay gain on the difference in the step up. It's kind of like, well, they leave, they get the step up, and then they just give it right back to someone. That's true. That's one issue. But by creating this net, it triggers all these other conflicting matters, to say the least.
Right. And it's interesting because if the individual just would have remained a U.S. tax resident, at least for transferred taxes on death, it would have been exposed to the estate tax, but at least would have received a fair market value step up. But with the deemed sale, you're taxed on that, and then you're also taxed at the recipient's also taxed at the estate tax rate.
Well, that's why you have to be careful. So basically, that's why we say try to catch this stuff a year or two before, because a lot of times it's going to sound crazy sometimes, but at the less than ultra net worth levels now, sometimes we want to preserve the green card. Sometimes we want to say, let's stay a resident, let's stay a citizen, right? Let's keep our 11 to 12, whatever it is at the time, exemption, right? Let's just retain all that. Let's avoid deemed sale on exit, and we'll be fine. If it's someone with $200 million, and let's say we work through the assets, CPAs are involved with that, and we work through the last 3 or 4 tax returns, and there's not a lot of gain. We say, okay, let's get out. And we don't have to give back assets into the States. The kids are going to get out also, or whatever the situation involves. And then you've got a clean expatriation. You have a mark-to-market tax, but it's only on gain. You don't have a lot of gain. Maybe what you have is down for the moment. It's very, very situation-based. Each client has a different scenario, which is why planning is so helpful.
Just so you have a foundation of 2801 and how it operates. These are some basic definitions we should all know. I mean, a citizen or resident of the U.S. is pretty straightforward. It would be what it would be under for other estate tax or gift tax rules. This is important for the recipient of the gift. Mm-hmm. This is where it would apply. So if they're domiciled here, then they're a citizen or resident. That's
right. Yeah,
that's the rule. Mm-hmm. And then a covered gift or bequest is anything that is acquired and transferred by gift or at death through an estate that's received by a U.S. citizen or resident from a person who's a covered expatriate, which just means that they were subjected to the mark-to-market when they left. That's what that means. So if someone expatriates, they pay them the mark-to-market, and then they later make a gift to a U.S. resident or citizen, then this would apply.
Again, a lot of times we can make those gifts beforehand.
That's right. And use the credit they have.
Use the credit. That's right. Use the credit. Use a unified credit. And also, depending on the wealth of the client, we may be able to gift to the extent significantly and bring them under the exemption amount for expatriation.
That's right.
And then you're done. You don't have any more issues.
Because remember, it's a snapshot on the day they leave. What do they look like at that time? Mm-hmm. There's also potential planning to get things out. We can also leverage the traditional estate tax mm-hmm. techniques that we have in the U.S., grats, idjit sales, things like that can be utilized. That's why it's important to plan beforehand to see what's the best option for the client.
Sometimes the client, especially someone who's retired, says, I just need a certain income every month. Basically, it doesn't really matter where I live, depending on their wealth situation. I need, let's say, $50,000 a month. That's a lot. Obviously, that's a lot of money to some people. Some people, it's not a lot of money. They need $50,000 a month. Well, what we can do is get assets into, let's say, simplistically, a grantor retained annuity trust. We move the assets in. They're gifted out. They're outside the estate, and the client retains $50,000 a month. That $50,000 a month is gonna really reduce their estate tax liability, and it may get them under. Probably won't at 50, but at some number, maybe 15, get them under the amount by which the mark-to-market would apply. And that's just basic U.S. planning. With a foreign trust, we may be able to do even more. We may be able to get them out without renouncing. They can become a non-resident for estate tax purposes, which there's some tremendous advantages of that, even though they're a U.S. income tax resident, or vice versa, depending on the planning. And that we may be able to reduce the mark-to-market and the estate tax through that means as well.
The interesting thing here with the definitions is, who a U.S. recipient is. Not only is it an individual, it can also be a domestic trust, a foreign trust that likes to be treated as domestic, or domestic entities.
Yeah. Which is a trap.
Now, there are some exceptions to this regime. One is if the gift is taxable, it's covered under the gift tax, then this isn't going to apply, because this is supposed to be something in place of the gift tax. So if a covered expat makes a gift of a U.S. asset
over 23 million.
Right. So taxable gifts would then be excluded from this tax. Also, if they die and they own U.S. real estate or something like that, or U.S. property, and it's subjected to the estate tax, that's not going to be taxed twice with the 2801 if a U.S. recipient receives it on death. Any transfer to charities is going to be exempt. Public policy reasons behind that. Transfers to a U.S. resident spouse that's in the U.S.
U.S., not one that's leaving.
Right. U.S. Qualified disclaimers, as we talked about before. And it's just important to understand that it's based on the idea of domicile of the person who receives the gift. And domicile for estate taxes, for U.S. transferred taxes, is based on two elements: physical presence and intent to remain. If you meet those, you are a U.S. estate tax domicile individual.
Not related to income tax.
That's right. That's the green card or substantial presence.
Right.
So as we said, the beneficiary is the one that is responsible for the tax. It's interesting that all the foreign trusts themselves, if one exists, is not responsible for the tax. It's the U.S. beneficiary who receives the gift or bequest or distribution, even if it's indirectly, is responsible for paying the tax.
And remember, when that wire comes in, the IRS is aware.
And if it's for an entity, it might be indirectly, but they're still responsible for that. They actually receive the money themselves, but they're still responsible for the tax, the recipient. So now that we understand how this works, who it applies to, when it comes into effect, now is how do we actually calculate the tax? Well, this is a lot like the GST tax, the mechanics behind it, having a ratio or understanding that there's no amount that's exempt. So if 2801 applies to the gift or transfer, depending on what it is, if it's a gift, it's going to be the highest gift tax amount, and if it's a bequest from an estate or a trust on someone's death, it'll be the estate tax. It doesn't really matter for us because right now those rates are unified and they're the same, but that's how it operates under this regime. And it's calculated by each year annually. The U.S. recipient has to add up all of their net covered gifts and bequests in a year, and then they're able to subtract a $15,000 credit, which is the idea being if it was an annual gift exclusion, that's why it's there. So if you received it, you could get a $15,000 exclusion, but the rest will be taxable
40%.
under this at 40% for this regime. And they're valued as of the date of receipt, the fair market value. Which if it's if it's a stock or something, it's easy. Other things might be more difficult to value, but that's where they base the value on. And what's interesting is the basis is unaffected. So even though you might get this thing and it's valued at $1 million, but the cost basis of the person who actually obtained it, the covered expat, is $600,000, even though the recipient pays the 2801 tax on this and pays 40% of the value, their cost basis, their tax basis in this asset remains $600,000.
Yeah, it's basically not doable. Basically, this is one of those regimes where you've got now the expat out of the country. They find the firm, or they find a tax advisor who knows what they're doing, and it's a workaround. We try to work around this because they've paid the mark to market, they've paid the gain on the assets already, and now they basically can't saddle the child or whoever it is they're giving to in the States with a 40% tax on the value of the asset with no step up, right? I mean, it's basically not an option.
It's very unfair. The other thing is just that the fair market value has the meaning of everywhere else in the code, which is just what a willing buyer would pay a willing seller.
Yeah,
without being under compulsion to buy or sell. Which if it's something that's not easily valued, then you probably have to get an appraisal, I guess. I mean, depending on the asset, but just something that you need to be aware of, and that's how the IRS is going to compute this tax.
Well, they'll just send you a bill too for a lot of this stuff. They'll put whatever value they want on it.
That's right.
Right?
That's right.
That's what I've seen.
That's what I've seen too. So how do you determine the date of receipt? This might matter based on, especially right now with the current market, it's all over the place. It does change based on the nature of the gift. If it's a gift, it's the date that it would be for U.S. gift taxes. So the date of the transfer and the relinquishment of it and the receipt by the person in the U.S. A bequest is pretty straightforward as well. It's the date in which the distribution from the estate or the decedent's trust is actually made, not on the date of death, which could be
it's not when the foreign trust. I think the point on that one, it's not when the foreign trust is funded.
Right, it's when they actually make
even
the
if it's got the U.S. beneficiary, it's when the distribution takes place. They give a little break there. Right. Not much break in this law, but a little break there.
And unlike the estate tax, there's no alternate valuation date, so you're stuck with it. It is what it is. The same thing with a foreign trust would be on the date of receipt. So the distribution from the foreign trust is made to the U.S. Benny. And then depending on the other types of assets, if it's operation of law, beneficiary designation, contractual arrangement, it would be the date of death because it's by operation of law, which is how it is in U.S. law anyway. So how is it calculated? I have an example here. I know this can be tough, it's just math, but basically you have a U.S. citizen who receives a $500,000 covered gift from B and an $80,000 covered bequest from C. Both B and C are covered expats. In this example, the estate tax and gift tax rate is 40%, which is what it is right now. The U.S. donee, the recipient, does get a $15,000 credit in 2020, and we know that the tax rate is. So there in the bottom, I've calculated that. If you add it together, it's $130,000, but they get a $15,000 credit. The U.S. recipient does. So actually, it's it's 1/15 of covered bequests or gifts in a year.
That's the tax. That's
So the tax is 40% of 1/15.
right, with no basis step up,
With
even
no
for
basis.
the tax paid.
That's right. So in a lot of ways, I mean, you know, it's pretty straightforward if it's just a direct gift.
If it's two people with one gift, but it can be pretty
It's
involved.
very similar to a GST direct skip.
That's
you have a
when you're
direct
skipping
transfer.
a generation.
Right. That's sort of the best way to look at this.
Well, it's like the only other example.
Right, that's like this.
It's very uncommon.
It's very uncommon. So if you have a foreign trust, though, there are special rules because you might have assets in a foreign trust that aren't covered. Some are uncovered. So there's a formula to tell you how to calculate that.
Yeah, you're blending pre-expat assets with post assets.
Right. So it's just an explanation here. So if you have non-covered and covered gifts and bequests in a foreign trust, a portion of every distribution will be taxed based on the ratio of the trust. It's just like the GST. It's the exact same.
Yeah, it's not a first in, first out or anything like that. It just blends them all up and makes a fraction, and that fraction is going to be taxed.
Right. And the formula to figure it out is first you have to calculate, you know, when the distribution is made, you have to know how much that is. You have to know what the ratio is for the trust, and then you calculate the tax by multiplying the ratio to the amount distributed.
Some of the software can do this as well.
Yes, this is an accounting. So this is the formula. It's pretty straightforward. You have the pre-contribution fair market value of the trust times the pre-contribution ratio, if any, that exists.
And then that's right, if any, and then also obviously if there's planning involved, we don't blend.
Right, exactly. It's like a GST trust. You would have it by itself.
Yeah, we don't make it.
Right.
But if you have to calculate, that's how you calculate.
And then you have and then once you make the covered into the trust, you'll have a total amount in the trust, which is on the bottom, the denominator. That's how you get the ratio. And it could change over time if more gifts are made. So here's a quick example. $20,000 is contributed by A and B. A is covered, but B is not. It's pretty easy. The math's easy. It's a 0.5 ratio. And that's how it's calculated. It's really easy. So 50% of every distribution from the trust, assuming there's no other things that are given to the trust, would always be covered under this 2801 tax. That's easy. It's straightforward.
Great example.
Now you can avoid this by electing to be a domestic trust,
which has its own issues, and those issues correspondingly, those numbers would have to be run because you're going to subject assets to the U.S. income tax by domesticating that trust that otherwise wouldn't be involved. You'd be a foreigner, non-U.S. citizen or resident with a foreign trust. A lot of those assets will have no relationship to the U.S. and not taxed. If you bring them all in, you've got to calculate to see, pick your poison.
And then if you were to elect to be a domestic trust, it's Form 708, just so you're aware. So what can you do to plan around this? I mean, it's really a pre-expatriation planning.
It's very important.
I mean, it's very important. I mean, that's
and it's one of those planning structures that really works. I mean, you can really get stuff out of the estate. You can retain the income for the client. You can pick and choose among your beneficiaries. Some kids are going to stay. Some kids never came in. Some kids are going to leave. You can allocate appropriately to avoid the tax. Once these people leave, it becomes very, very difficult. And many non-citizens who come in and intend to leave after 8 or 10, 12 years, I'm speaking to the professionals here. They're not going to have the background, nor in many cases will they get beyond the jaw-dropping tax associated with expatriation. So the key is to try to grab it before you run headfirst into it.
So, the planning before the exit is probably the most important thing. The other thing would be is if someone is covered and they're out, if they have a green card holding family member that's in the U.S., they might domicile in a foreign country for estate taxes, and that might be a way for worldwide assets to be gifted. But that takes planning as well. But it's very limited once you're covered and you're out, and you try to get stuff back into the U.S.
Yeah.
It's just electing to be a domestic trust, really. If you have a foreign trust, that's not really much otherwise you can do to avoid this.
If you have any questions, our information's there. And we're available all the time. You can call or you can email us. We really get our work from the community and our referral sources. We try to remain a resource on tax, corporate, and international issues. We try to give a seminar up to what do we do, about 1 or 2 tax and 1 or 2 non-tax. We do a lot of medical work, as medical regulatory work, and probate guardianship type work as well. Maybe every 3rd month we'll do an M&A, a mergers and acquisition, or a corporate seminar. Okay, then we'll sign off. Thanks so much for attending today.